welcome to the longest intro in the history of your life. I hope everybody's having a good day. It is 9:22 on Tuesday, June 9th. Wow. All right. I got to get my image in that picture, that video. That was exciting. All right. Good morning, everybody. Good morning, Big Cap. Good to see you, man. Haven't seen you in a long time. I hope you're doing well. Good morning, Vicky, Eric in Northport. Thanks for joining us. You could be doing a lot of things on a Tuesday morning, and you've chosen to join us. We are on a little bit of a different screen setup today, and I am kind of driving the bus in a way that may or may not go over a cliff briefly. Did I share it right? Probably not. Let's try again. Can't tell. Nope. Hey! Look at that. Nailed it. You're welcome, everybody. This is just 4 years of journalism school wrapped up into one great interactive experience. That's all you can ask for, and it is positive momentum. Look, we had a big sell-off on Friday. Don't tell us that we didn't tell you that was going to happen last week. And then we had the bounce back. We had the squeeze. We had the excitement. We're always open with momentum. The morning momentum just lived through a violent week. Friday was a crack in the system, and I'm going to explain today something that you probably have never heard before. You're going to look at me and you're going to say, well, actually, you know what? Eric in Northport's heard it because he's probably heard it 400 times. But the rest of you will probably look at me and say, what are you talking about? Well, basically, I'm not going to tell you that you've been lied to. I'm just going to tell you that the entire financial system was rewired in 2008, and they never told you. And what just happened on Friday and what happened yesterday and what is likely going to persist over the next month all goes back to this single thing. And that's what we're going to be digging into. Where does momentum actually lead to right now? Well, memory and chip equipment are back on top. AI and compute is being defended all over the world right now, and the down days money ran straight into defensives and regional banks. But what cracked? The most crowded longs got hit hardest on Friday. Software, quantum, space, both Bitcoin and gold sold off as yields and the dollar moved higher. We have to pay attention to the US dollar. Very, very important that you're always paying attention to where we sit on the dollar index. Over 100 is not good. That is where collateral quality is impacted. That's where the wiring that I'm going to lay out to you today gets beaten up. But core thing here, the whole story, leadership is razor thin right now. And that line right here, 74.51, the 7,400 level that we talked about was defended. That is your line in the sand. That is where the institutions are playing defense. And if this flips, that's where things start to wear off and start to break down very, very quickly. Now let's dive into the nice little presentation that I built for you this morning and everything that comes with it. And there's a nice little picture of me. There's Chicago in the background. There's a pipeline that I've seen. There's Washington, D.C. Don't make me go back down there. Momentum, again, semis had their worst day since COVID. And I want to point something out. There's a big difference between a global pandemic and a risk-off event. So what we saw on Friday was the unwind of concentrated risk that has persisted since our signal last went positive, which was April 7th. We built and we built and we built, and then it broke. And now it's starting to rebound a little bit. It may be repricing, but this is the exact same thing that happened in January. We went negative, and what broke? Where all of the concentration landed. It wasn't in the semi names then. It was in gold and in silver. That's where there was ample speculation at the time, where gold had gone from about 4,200 to 5,500 in about a week and a half, and silver hit 120, and then it cracked. It broke. And that's why I'm going to continue to repeat this until I am blue in the face. This is how the market works, and I'm going to lay out to you over the next 10 minutes how this system works and how these unwinds break, and how ultimately, if you are not playing defense, it can cost you significantly. So we had that nice little snapback, 5.6%. The VIX pulled back. Again, we talked about the SVXY and the UVXY and the differences between the two. Volume weighted average price with volatility trading, UVXY, SVXY. The SVXY is short volatility. The UVXY is long short-term volatility. I know that sounds like a contradiction. It just means that we are bidding into volatility increasing in the short term. Okay, So the stocks to be trading today. We've talked about volume weighted average price, but let's talk about where trend lives right now. The strongest breakout names right now are CRL. I couldn't tell you what that is. Sounds like a band from the 1990s, probably some sort of alternative cover band that I would not like. Charles River Laboratories. Okay, you're going to see a lot of healthcare names, and that's important because when tech does break down and when momentum starts to crack, we actually do see rotation into healthcare and a little bit of biotech focus. So you have Humana on the healthcare, health insurance side. You have Eli Lilly showing strength. You have Evolve, ELV. CVS is one of the strongest momentum stocks right now, which is shocking to me because I already made this joke today, but it bears repeating on how much money they spend on printer paper. That's Walgreens. That's way too long of a receipt. CRL. On the downside, you got Charter Communication, Coinbase still under a lot of pressure. That is important because of the current state of affairs around what's happening with crypto. Pepsi, PEP, PayPal, and Tyson. Okay, so once again, the consumer defensive, the consumer food groups, the consumer names under some pressure. PayPal under pressure, Coinbase under pressure. These become VWAP names. These become the names that you start to target for short-term focused, maybe going into Friday, and looking at key moving averages. So let's do that real quick before we go into the full breakdown today of what is happening in the way that the markets are wired at the moment. Core thing I want to focus on is just take any chart. Pick a chart, any chart, doesn't matter to me. Let's go with CVS, okay? CVS has been a very strong momentum stock for the better part of a month and a half. This flipped over positive in April. It had a hell of a run. Positive crossover, 8 and 20-day moving averages. Continued strength above that 8-day moving average. We hit overbought on both RSI and MFI, and then we cracked. Okay. This is a lesson that when it comes to momentum stocks, you want to pay attention on the daily to the RSI and the MFI. The RSI is the price momentum oscillator. The MFI is price and volume. And a funny thing happens when we get into overbought on both of these. Overbought is 70 on RSI and 80 on MFI. When we tend to peak out, that becomes the opportunity to now start to go the opposite direction. We broke under the 8, we tapped the 20, and we have rebounded since. We never got under 50 on the RSI, and we have been rebounding since. So what becomes the trade out of this? Well, there's a lot of different positioning ways that you can trade a name like CVS right now. You can sell put spreads down at the 90 and 85 level. You can buy in the sand right here at the set a line at maybe 97 bucks and sell 100. You can buy the 95 and sell to the 97.50. What matters is that you pick a position that meets your risk tolerance, okay? I want to point this out. A lot of people want to come and they want to hang out this morning, and I'm going to tell you, I am 45 years old. I feel like I'm at 603, but I have a much different risk tolerance than you do. Much different. So, yes, you might want to make 100% on your money. Everybody wants to make 100% on your money. But sometimes it's about setting a line in the sand, knowing exactly what your potential gains are if you just recognize how to trade it. So VWAP becomes very important off the bat. VWAP is your institutional line. And what we know right now as we go live right now in the market, we're going to let this kind of, settle. Well, once again, we had a sell-off to start the day on CVS. We hit 95, and then we popped back above VWAP at 95.50. And for the bulk of the day, in an ascending volume-weighted average price, this went from 95.50 to 97.25. Doesn't sound like a lot of money, only $1.75? It's huge for traders. Okay, it's a huge amount of money for traders because if you're trading short duration options, if you're defining your risk up front, you can know right off the bat, okay, this is exactly what I can make and what I can't make. So right now this is selling. We're going to let it kind of do what it does. We're going to let these Bollinger Bands expand. We're going to let the deviation lines expand a little bit. And what we're going to look for is a continuation of trend to the upside for CVS. And that means right now in the first 15 to 20 minutes of trading in this session, We don't take any action. We just simply wait for the setup. And the setup is going to come as volume kind of calms down and as we move into later period of the day. So at this point, the way that I'm estimating this and the way that I see where volume weighted average price is right now at about 96.77 is that I'm going to be interested in doing something as simple as doing a call option. So here is Charles Schwab. And rather than buying the stock, I can do a vertical call. And we're just going to walk through this. We're not going to make the trade right away. But if we go out to next week, that's where the option chain expires for OPEX next week. Right now, as we look at CVX, currently at 96.80, currently sitting right around volume weighted average price. Let's wait till about 10 o'clock, okay? Because at 10 o'clock, what we can then do is we can look to see if we can buy maybe the $95 call and sell something like the 98. And what that will do is it's going to give us a spread. Now, as you can see, these are very wide bid-ask spreads at the moment. We want to wait a little bit. Again, the market just opened up. This should narrow in the next half an hour. And what you're seeing right now is I am defining the risk by doing a call spread instead of trying to force a simple call. There are a lot of different ways that you can measure this. We have a option calculator that we built. So this is our option calculator, and here is CVS. Right now, CVS has an implied volatility rank of 30. Typically, I don't want to be doing a lot around that specific level. I want to be under 25 when I'm buying calls, but I'm going to make an exception because, once again, I'm going to be focusing on a call spread rather than just a long call. If I went out to next week, very simple, very important that we just note this. The at-the-money level is really around $97. Out into next week, the max profit that you can make if momentum continues is unlimited. The max loss would be the value of the call that you're buying. So that's 213 right now. That means your break even is 99.13. Why does that matter? It matters because that's actually above where the recent high was. So if this stock moves up, right? If this stock, it's probably, let's be fair about this, it's probably not going to make the move past that level. We're going to look for a double top on a name like this. So we have to define the risk up front and change the way that we consider this. 31% probability of profit. Well, again, you're only focusing on doing this trade if the conditions align, which means we need CVS to move above volume weighted average price. We're talking about 10 o'clock here, maybe 10:30, and you're looking for a continuation. Well, let's just say that we try to get to like 98.50, right? Back toward where we were in recent highs. What that gives us, if we do a call spread, is something completely different. And if we bought the $95 call and we sold the 98, the math is going to change dramatically. We went from a 30% probability of profit at the money call into next week to now setting up a trade that will cost us, by buying the 95 call for next week and selling the 98, you could see your probability of profit has changed dramatically. It's gone up to nearly 50%. Your return on capital is 60%. Now, everybody wants to make 100%. I get it. You know what I would like? I'm happy making 40%. So if I look at this and I say, okay, the max return that I can make is 60%, and my break even, by the way, is 96.87, which is kind of like where VWAP sits, then I have defined my risk completely up front. And I know exactly what I am targeting over the next week, and I know where I need the stock to go by simply looking at a P&L analysis of the movement of the equity over a period of a couple of days. So if the stock goes back to 98, I'm going to be in that 40 to 50 to 60% range. Obviously, the closer that we get to the expiration, and if we're over this level right here, it's a lock to pull in the gains. I like spreads way more than I like single calls. I only like using single duration calls when something breaks in the market or something is unique in this market that we hadn't seen in a while. And what I'm telling you, what I mean by this, I will only buy calls on things like the SPY or NVIDIA or some of these other names after a momentum flip, after a flip on this score. So an example of this, April 7th, momentum turns positive. That's where I will buy something with a very low probability, because what I'm looking for at that exact moment is where all of those institutions step in and they are forced buyers. You're going to get maybe 1 to 2 to 3 of these a year. But for the rest of my time, it's going to have to be about defining my risk up front and knowing exactly what is the level that I am willing to step in and buy. And right now, it's not here. We are currently sitting on a bid ask right now of 96.42 versus 96.93, or forgive me, 63. I want to see some volume come in. I want to see these Bollinger Band, or forgive me, these deviation bands expand. And I want to be trading on the right side to the upside of volume weighted average price. Or in the event that we do see, for some reason, a big sharp sell-off or correction that ultimately takes us down into oversold for the day with these deviation lines. But for the most part, it's just simply about trying to focus on momentum continuing here, buying down here, selling up here, and looking for a continuation of that trend. And the nice thing about that is, look, this is what the broker-dealers are doing. Because the broker-dealers, if they're selling calls, they have to position themselves, which means they're buying. And again, you're buying too by buying calls down at the 95 level and selling at the 98 level. So you're buying at the extremes of these bands. That's the setup that you're looking for today. CVS is in that list. You have a couple other names, very clean. Not a whole lot that you have to really worry about. This is going to be a relatively quiet day. We have a CPI number that comes out tomorrow. That's going to pretty much dominate all of the conversation for the better part of the next couple of days. So let's focus now on the real story of this market. I'm going to try to do this as quickly as I possibly can. I know that I'm going to use a couple of big words. And in fact, I may not even be able to get to the conversation that I was going to have about the CPI print until tomorrow morning. But I want you to hear this, because this is one of those things where people hear this story and they say, no way. No way. There's no way that this is real. And I go back and I tell them, no. The head of the Bank for International Settlements actually just did a whole speech on this, and it was not covered in financial media, save one publication. And that goes back to 2008. When the financial crisis happened in 2008, there was a major shift in how the markets were financed. The banks stopped doing what banks do, and instead, we started to see what was effectively a rewiring of the markets. They did not repair the old machine. They simply tore the wiring out, and they built an entirely new one. Government debt has quadrupled since then, and it became, this is important, the collateral that the entire system borrows against. Michael Howe has argued that we do not finance growth anymore. We refinance growth, meaning that every new dollar that is created, that is ultimately used, 6 out of 7 new dollars internationally, is used to refinance debt instead of financing growth. And that is important because hedge funds have replaced central banks today as the marginal buyer of bonds. Now, why does that matter? Because they buy with borrowed money stacked on top of borrowed money at almost no margin of safety. And this is why you are seeing these sharp corrections. You are seeing these V-shaped recoveries. This is my argument, my thesis. But the point that I'm making here is what happens at the end of the day, the entire focus, the centralized focus of the Treasury Department, of the Federal Reserve, of the Bank of Japan, of the European Central Bank, their centralized goal is to create stability in the bond market, because the bond market, particularly short duration Treasury bills, are the primary focus of collateral in the market, and that collateralization is one of the major drivers of equity performance. Underneath all of this sits a hidden market called FX swaps, around $130 trillion of it, and it's bigger than the entire global stock market. So risk did not disappear after the crisis. It moved to a place that few people even know exists. So when somebody quotes you a statistic from 1987 or 1974 understand that they are describing a machine that was scrapped 17 years ago. And the ratchet that matters most, every time they ease, the system gets structurally bigger, the money sticks, it never drains, which means no matter how tough they talk over the next couple of days and weeks, all roads still point back toward monetary expansion down the road, and thus higher equity prices. This is important. Everybody here, we all sit here and we say the U.S. government debt is out of control, and no doubt about it. But the whole financial system looks at the debt and says, ooh, give me more of that, because that's actually the collateral that's utilized to finance the continued growth in equities that continues to concentrate into a smaller number of names year after year. And right now, that concentration is in the Mag 7, the semiconductor names, and the AI trade. And when we layer this on, this is important, okay? For the very first time in decades, every major central bank is leaning in the same direction, and that direction is to tighten. The Fed meets next Tuesday under a new chair. His own people are debating hikes, not cuts. His line is that inflation is a choice, and that is true. The European Central Bank is hiking into a weakening Europe. Bank of Japan is raising rates to the highest level since 1995. This is the end of free money. So you saw a preview on Friday of what is likely to come into what we are seeing is the most leveraged machine and hidden machine that was ever built. And with one strong jobs number, cracked the whole thing in an afternoon. That squeeze, this machine can go on for a while, but it cannot squeeze forever. And the next test is going to be CPI tomorrow. It lands tomorrow. And that is why we want to be prepared for the trades. First core thing I want to focus on is chipflation. Okay, this is the call that has worked. I told you memory was the freshest setup on the board. Monday it ripped. Micron jumped 10%. The chip names led to the entire bounce. And here's why it's likely to keep going. Memory prices are up more than six times in a year. And the market is doubling toward $890 billion. And supply stays tight all the way through 2027. So the names are Micron and SanDisk and Western Digital. And it already gapped. So I'm not chasing it here. I manage it, and I sell put spreads into the pullbacks to get the pad weighting. This is important because, once again, you have to change your strategy a little bit. You have to think a little bit about what is it that I am going to do at any given moment. We are reactive here, and I want to stress this. I am a very reactive trader. I don't sit here and go, oh, I think Micron's going to go up 3% today. No. Because at the end of the day, it is algorithms, it is machines talking to one another. I have to understand how to navigate that. So I take a name like Micron, and I do something that people don't do for some apparent reason. People get too what I call qualitative, right? They have a thesis and they want to chase it. And then they can't figure out why it's not working because they're not understanding the true mechanisms and who's actually trading all of this. Micron pulled back this morning, hit the 4 standard deviation right there, probably moved outside its Bollinger Bands, and then squeezed $20 only to hit VWAP right there and has rolled a little bit back. Okay. All of those names become intraday trades, and they get even better if they have zero-date options, and they get even better if you move into the end of the week where the Friday operates and you have that weekly OPEX. What in this chart right here would make you want to go long Micron? Right now, at this moment, it's at 946. The answer should be nothing. But if it pushes above that VWAP right here, this becomes the opportunity to trade not just Micron, but also leveraged ETFs linked to it. And we look for a move from here to here, which is only $7, $8. But in the land of trading and short duration, it can be quite a bit. And again, I go back to, well, what if I bought a call here, down in the money, rather than trying to chase up here where my higher probability of profit sits? This is going to remain the trade, and it's going to be up and down, largely dependent upon whatever the reactions are to CPI. But I also have to highlight one last thing. The thing that people aren't understanding about what happens when it comes to the Federal Reserve maybe raising interest rates, or what the ECB may do, or what the Bank of Japan may do, it actually doesn't matter what we think. What matters is how hedge funds are positioned ahead of an announcement. The Bank for International Settlements, something that a lot of people don't pay attention to because they probably can't point it out on a map, also did research on this. And they went back and they assessed 4 major moves by the Swiss National Bank in the last 15 years. And I know you're sitting here saying, Swiss National Bank, who cares about that? Well, it does matter, because the Swiss National Bank, there were a lot of people who were hedging the Swiss currency against the European currency. And on 2 occasions, they made a surprise announcement, and funds were long the euro. And in that case, the Swissy actually ripped, the franc ripped against the euro. And all of that positioning led to a significant unwind, and 2 hedge funds blew up. I believe one of them was called Anchorage, not Anchorage that's here. I believe it was named after up in there. But two cases where they made a 25 basis point move, and the funds were positioned fine, and there was no crash. So the question now is, when we look at this for next week, what we have to look at on Friday is the commitment of traders report, and assess where funds are sitting right now in terms of being long US dollar, long euro, long yen, etc. And my expectation largely is most people are probably going to be positioned pretty heavily against the yen right now, even though they probably shouldn't be. And if there is some announcement next week around the Bank of Japan and this unwinds, it will unwind very quickly. And it did so back in August of 2024. Now, once again, the only thing we have to do is watch this. Because when this starts to break down, it is telling us that there is funding stress in the system itself. Momentum in the broad market, this reading, which again, and broke down on February 21st, 2020, broke down during the Archegos event, broke down at the end of the summer in 2022, right before the gilt crisis, broke down on March 7th, 2023, 4 days before Silicon Valley Bank imploded, broke down on August 4th or August 1st, 2024, 4 days before the Nikkei crash, broke down a month before the trade crisis, broke down in January of this year before the gold unwind and the Korea sell-off and the broader momentum sell-off. Liquidity and what we're watching lives upstream of momentum. And when momentum breaks, the biggest and strongest companies in the world go with it. And I'm going to give you very quick evidence of this. So this is why I'm going to tell you now, when this goes negative, your opportunity becomes to short NVIDIA and the Mag 7 and the big names, because what is happening is that is leverage leaving the system. And a good example of this, the finest example of this, the best example in the history of the world, was back here in July of 2024. When that went negative on August 1st, NVIDIA went from 120 to 90 in 4 days. NVIDIA also went, over the period of the momentum sell-off that started in the Russell, from $135 to $90. Why does that matter? It matters because NVIDIA was the top company in the world. Nothing changed in the thesis around AI. Nothing changed in the thesis around chips or dominance. This was mechanical selling. And these mechanical sell-offs that are transpiring because of that rewiring that I discussed, and because of the way that things are set up and the way that things are operating in the plumbing and the financial system, when that all goes to hell, this stuff goes with it. So another example of this is going back to November of last year. November of last year, we started with some weakness. We sold all the way into November 21st. That was the time that Japan turned around and announced more stimulus. But again, the thesis on NVIDIA, this stock went from 212 down to 172. Nothing changed in NVIDIA. It still is considered the greatest company in the world, and everybody loves the CEO because, again, It has nothing to do with its earnings. It has nothing to do with its fundamentals. It has nothing to do with the chip growth. It has everything to do with the plumbing of the system and how it unwinds. And I know that this may be very complex and a lot before 10 o'clock in the morning on a Tuesday, but I'm just simply showing you the whole system changed after 2008. And the opportunities are going to persist when we have these momentum flips. We went negative on January 28th. NVIDIA went from 192 all the way down to 172. We turned positive on April 7th. Clear as day. Stock goes from 177 to 235. And that creates opportunities to trade things like the NVDL. What the hell is that? Well, this is the leverage in short-term ETFs. Positive flip happens here on 80. This went to 130. If you were just trading simple options out of the money, 80 took you to 110. This is the type of thing that produces about a 1,500 to 2,000% return if you hit the right thing. And if you're just conservative, you could sell spreads on NVIDIA. You can look to the downside and just try to collect 20%. There's a lot of different ways to trade these types of things. But once again, these momentum events, these big flips, they're not that common, or they weren't historically common. What happened was we would have a major financial event, 2008, 2011, 15, 18, and then COVID. Since then, however, we are having one or two major momentum breakdowns post-COVID. The most recent one was in January. The one before that was in late November. The one before that was April of last year. And right now, with concerns around the regime change tied explicitly to the current state of affairs with higher interest rates, this is the stuff that can and will break down very quickly. But it is important to note that this level and that level can hold a lot longer. You are looking at a pure reflection right now of the strength of the collateral market, and you're looking at the current strength of the margin accounts and the money that is in the system at the moment. And when it unwinds violently. So that's why I like to just wait for those days. I just hang out until then. And then at some point, what we will look for if we do have a major breakdown, two things. We look for a move to oversold conditions and a potential policy accommodation by the central bank or by the Treasury Department. And we also look for a major amount of insider buying activity on the aggregate. And the last time that we saw a significant amount of insider buying was March 31st. And a week later, momentum returned. And the Treasury Department accommodated by adding about a $200 billion drawdown in the overall Treasury drawdown of the Treasury general account. And one last thing about that. So remember, I said that we rewired with U.S. debt. One of the key things that is important to note is it's not about quantitative easing. It's about stability. And what do I mean by that? Why is that so important? With the Treasury Department and what other central banks are trying to do at many times when we hit this period of significant amount of concerns around selling in the bond market, what they try to do is they try to not step in necessarily and buy bonds. They try to prevent sellers. They try to cool off the selling, and what they are effectively doing at that point is saying, hey, we're going to step in, maybe we're going to do some action, maybe we're going to buy some 7 to 10 year bonds, then turn and move that debt toward the front end of the yield curve. Why does that matter? It makes the sellers cover their short positions. It makes people say, oh, they're going to move. They're going to do something to try to stabilize. I don't want to be caught on the wrong side of that. And one of the other things that I will point out, it's very clear. Every time that it gets just to the darkest point, every time that it looks like it's just going to completely and totally go, a single tweet can change everything, and the short covering begins. And that's how we see these sizable squeezes. That's important, right? Call off Liberation Day. Call off the war. Say that there might be a deal between so-and-so. Nobody knows. What matters is that there is a perception of it. And if there is a perception of it, that sends buyers into cover mode, and that eliminates those deep concerns on the marginal buyer and seller that move us away from panic. As we dig deeper into this, and we talk about this over the next couple of days, the things that are really going to be important for you is just to recognize that these trends are not going away, right? Intel is a real trade. We talked about how to trade it if it gets to a very specific level today, if we hover around these lines. We are seeing right now that Micron is bouncing around. It has just pulled back once again, but Intel is now down to 111. Or that's, yeah, INTC. I must have been looking at INTU a moment ago. That happens from time to time. Is that what I did? I did. That's because INTU is a breakdown stock at the moment. So INTC is currently at 111. My momentum focus would be at the 112 level for a name like Intel. And again, the same thing that I talked about earlier of a long call. Right now, the stock's breaking down. What we're looking for is a reversion in this name, hopefully at a later point today. And that's where the 110 for Friday, you buy the 110 and you sell maybe the 120. But again, you want to be back above volume weighted average price. Forgive me, 112 volume weighted average price. On the grid, also major theme, major story. We've said for weeks that AI needs electricity in the grid supply. So these become names for reversion trades. These become momentum trades, 8 above the 20-day moving average. Bloom Energy and GE Vernova for turbines use weakness to find the risk and sell put spreads on some of these names. The big story, of course, is just going to be the print. Tomorrow, we get the CPI number. The headline is expected to run hot around 4.3%. The core number is actually what's going to drive the conversation tomorrow. 2.9% is the expectation. So the market's going to trade one or the other. You don't know which one until it prints, but you don't have to predict it. You just have to recognize that 7,400 is the line in the sand for the S&P 500. You own protection to that number because it is still cheap. And then you react. A hot headline favors energy and financials. A soft core fuels a relief rally in tech. You trade off that level. You do not guess. Just keep that focus. So the bounce is narrow. SPY, momentum, SMH, all in focus. Looking for breakdown reversions. Be willing to bet either direction the next 24 hours. It's probably going to be a little bit quiet. And then tomorrow we get this news. But again, all roads point back to more monetary inflation, okay? All roads point to more money printing, more debt, and of course, more leverage. Every central bank is currently tightening all at once. They can squeeze it for a while now, but they can't do it forever. And that's why roads still point back to monetary expansion. Respect these levels now and understand that more continued focus over the long term in stabilizing this financial system, which is basically all they do, the more focus at the front end of the yield curve, where they effectively lend more at the first 12 months of U.S. debt, that's bullish for the market. The more money they move to the front end of the curve, the more that they sell in short duration is actually more beneficial to the equity system because those assets are like cash. They're cash-like instruments. Those are fuel for monetary rallies. Those are fuel for the ongoing commitment to financialization in the economy, and they become jet fuel for these kind of momentum rallies that we see. That's why we have to watch, instead of paying attention to what the Fed is doing, we want to watch the SOFR, which is the secure overnight financing rate, and that is what actually controls the repo market to which we are all beholden today. It is 10 o'clock, which means I hope you guys have a great day. I will hang out at a little bit. I know Mark's coming in right now.
Almost.
Maybe he's not. Maybe he is. Oh, there he is.
Not
all
Mark.
Right,
Mark
I got
is
Andrew instead.
today.
What's going on?
Me today, Garrett.
What's going on? I haven't seen you in a while.
I'm just I'm hanging out in Maine doing nothing except option pit.
Awesome.
You know, same old. I got sun. I have chickens, and we're waiting for the SpaceX IPO at the end of the week.
Very cool. Very, very busy. So, you know, one of the things that last time that we had chatted, you know, we've seen these like absolutely wild sell-offs. What was your reaction yesterday to, you know, just kind of the bounce back? It just felt like a traditional mechanical rally rather than anything fundamental or a repricing in the market.
Yeah, it was actually, I thought the rally was kind of tepid, to be
Mhm.
honest. After the sell-off was pretty hard, and then the rally was just kind of a little bit. There was no there. It
Right.
just whatever the reason was, they didn't like it. It seems like they didn't like the AVGO earnings or the the price for perfection kind of future look. And then everybody went sell, and now today that's all they're buying again. So
Right.
I think everything, and you're right. We haven't like the inflation picture that you were describing is anybody paying attention to this anymore, or more
Mhm.
importantly, does the market care anymore? Um, and I think if people can grasp, we have growth forever in AI, they can get
Mhm.
around, higher interest rates. And
You know,
I
I
guess we'll see this week.
I go back to an event that happened. It must have been 24 months ago. It was when Paul Krugman and Mohammed El Areen, were saying, "Let's just go to a 3% CPI target." And I honestly think that could very well be what they have done. In that they just remember they did not tell anyone for 18 years that the 2% inflation target existed.
Right.
Bernanke said it in 2010. Everybody's going, "What are you talking about?" I think it's possible. I think it's possible that they're using a soft 3%, and the reality is that's just jet fuel for a continuation of this trend. And everybody keeps looking at earnings, and they go, "Oh, earnings are great. Earnings are great." Yeah, because they keep printing money, and like it's earnings
Right.
inflation. It's not. It's not, again, the consumer seems tapped out. So it's a wild time to be alive right now because it's such a contradiction. And there was a great report from, I want to say it was BOA, but it could have been JP Morgan. They were saying, oh, it was Goldman. They were saying that the rally in the tech stocks is supporting consumer spending instead of the other way around, meaning that it's that they're seeing these numbers go up through the roof, and everybody goes, "Oh, cool, I've got money and I'm going to go out and spend." And now all of a sudden you see a day like Friday and a big pullback. The question is, is that sustainable? And
Right.
that's a little problematic.
I think part of that is that sort of the boomers are retiring, or getting really old now, to be honest. So they're looking at their equity port. Maybe they're selling some of their stuff and giving it to their kids. I always thought there was a little bit of that wealth transfer might be happening earlier and kind of propping people up.
Right.
Because at least in Maine, where I live here, it's kind of a vacation area.
Mm.
And like several families their kids are taking over the vacation house and the parents are moving to another house because they can't afford to buy a house. So the parents are like, okay, just live in the
Right.
vacation. Well, I know that sounds, but I didn't think that would happen, but it's happening. Now that's if you're a consumer, how does that affect your spending? Like all of a sudden you got your parents' house
Right.
and they're not charging them a lot of money for it.
Right.
Like it's almost like, because, and I love your stuff on like we're printing way too much money. So it's like the boomers are like, okay, we've kind of gotten away with murder.
Right.
We've printed all this dough for the last 30 years, basically, or 20 years, really. So now we're going to take our assets and we're just going to give them to the kids and try to just get out of this thing, just slyly sneak to the right.
Right.
So,
all right. Well, I'm going to hand it off to you. I want to make sure that I want to make sure I can just click this X and it's not going to kick you out, right?
I think we have somebody running the show, so I think you should be okay, Garrett. You're free to go about your day.
Thank you. You have a great day, everybody. Have a wonderful day. Thanks. Great to be here, and I will catch up with you tomorrow.
All right. Take care. All right, everybody, welcome. Hopefully we're getting, let me see what we got going on here. Hey. So you've gone to Garrett, to me. So what is going on today? We've got a little rally, but most of the rally, like Garrett was pointing out, is all in the big chip stocks. Also, I have a special guest at around 10:15 today. And what I find interesting is, so the safety stock, Apple, is going down. I don't know if any of you were following, but Apple does their yearly developer conference, and once again, Tim Cook's last developer conference, I believe, they came out with nothing new. So Apple is slowly kind of fading here, while the market is buying once again. They're buying ASML. I'm just looking at all the chip stocks I have here, all the big stuff. Google, of course, they're not buying Microsoft. NVIDIA is kind of flat, and SanDisk is up $150. So, yeah, Tim Cook's reveal is not a reveal at all. So, Apple as the safety stock, I would just say the same trend trading a market here is the market goes into all the chip and AI sensitive stocks. It goes hard into them, and then they realize how expensive they are and sell them off, and then start buying all the rest of the companies, like software companies. I'm throwing Microsoft into the software company realm. So you look at that, and now I look at like Zoom, but a company like NOW, which I think, again, these are like it was just $135 stock last week, and now it's back down to 110. So we're kind of still in this pattern of, I love all the AI chip stuff, I want to buy it up, and then the markets realize how expensive it is, sells it off, and starts buying up other stocks. And I don't see that trend ending anytime soon. The big elephant in the room is we have the SpaceX IPO that is going to grab a lot of dollars out of the market on Friday. So also we have, I believe Voz is doing an open house. She's opening trade to close on Wednesday, Thursday, and Friday. There will be sign-up links for that somewhere above if you want to look for them. But let's hit a couple of topics about inflation that nobody really is talking about. And what Garrett was saying about inflation being like tacitly higher, just take a look for this year. Now, I'm looking here. This is where we started 2026 is here. So interest rates are higher, oil prices are higher, and stocks don't care at all. Basically, and this is a topic here, especially with interest rates being like they are and markets being at the top where they don't really care. Now, if you think back before, right, before the markets went into, before we went into COVID, let's say, right? Everybody here thought everything was hunky-dory. Stocks were at relatively high prices. China was locking down or whatever, what the heck was going on. And we're still sitting here in the United States like, okay, that's not going to be a problem here until it became a problem here. So stocks have a way, and let's just take a look here at the S&P 500 on Friday. Right. Stocks have a way, and let's look at I want to just look at the last 5 days. Okay. Let's go 10. They have a way of not caring right at all-time highs until all of a sudden they do. And we're making what I would call a tepid recovery here. And again, the reason why is I don't expect VIX to do too much. We have a CPI number, we have a PPI number coming out, and then we have SpaceX on Friday. So I think the fact that VIX is going down overall into all of that is still pretty bullish for stocks in general, because every day that has gone by, we've had a pretty significant drop in VIX since the Friday peak. Right, here we are. Even Friday, by the end of the day, volatility was starting to sell off. Yesterday, it spent most of the day selling off from the peak. Okay, held up a little bit. And then today, we're having another drop. So you're getting real drops in options near the money. So when you're looking at that or trying to evaluate that, there's always a little trick here that I'll show you. All right. So you go here, you go out 30 days. And 30 days would take us a little bit after the 4th of July. So let's go to the 10th. And you want to look at options that are just near the money or just out of the money. So in this case, I'm going to look at the 750s. So we're going 30 days out. Option price is peaked on Friday on the 5th. And ever since then, they've been doing what? Yesterday, volatility down. So again, from 1460 to 1420 to 1405. So you're having a real drop in volatility after the event. What I would say is generally what you look for is that's kind of like a quiet bull, meaning traders are expecting stocks to be calm, but generally a little bullish on the upside. And I think that's what we're going to see going into the Trader X IPO. But we still have two big numbers that we're waiting on. And in 1 minute here, I'm going to bring Tim in to give us show us some fancy charts. But ultimately, we have two inflation numbers, and the key part is will the inflation number matter enough to move stocks around a little bit? Now in Rip Zone today with my students, we're going to talk about strangles and SPY because we're looking at volatility trading around a June 18th. I think it's a shortened week, but you have a 14 volatility going into these two big numbers in SpaceX. At least in my view, I don't think that's enough. Even today, we're going to end up, the market was up on the day. We're up 3/4, almost 1%, not quite. And we're already pulling back from that number again. I expect a lot of that back and forth all day long until all these numbers come out. So stocks are going to kind of move around, but volatility is not going to do too much. It's basically kind of a wait and see mode here. So I think this is an issue. We're also waiting for the first Fed meeting with the new chairman, right? Is he going to be a hawk? Is he going to be, is he going to be as hawkish as everybody thinks? How is he going to deal with, again, like Garrett would say, the money printer? So there's some actual, there are some actual issues around the next Fed meeting because there's some unknowns there that, I think Powell pretty much kind of stayed the course, but now all of a sudden we're going to have the Fed meetings could easily become something new again. Anyway, but it's about half past the hour, 1/4 past the hour. So I want to bring Tim on to discuss some of these things. And especially what I want to talk about is market tops. And once you get to a market top, sort of how that you can tell, right? Bank of America was already saying that, 70% of their indicators are flashing red. So they're telling clients to start to sell stuff. Now, this happened on the 5th, which was on Friday. So that might have been part of what we had going on. But I think I'd like to bring Tim on. Hopefully you guys have him in the background there to pop on.
Hey.
So Tim, is your title our macro guru? What is your official Option Pit title?
I think I'm the head macro trader.
You're the head macro trader. And I know we're waiting, I think, August for your product launch.
Yeah, they got a little bit of a tough July. I'm actually going to come out and see you. We're going to do this in the back channel. I was going to see if we can come. I don't know if we have a room. We could do a simulcast. It wouldn't even be a simulcast. What would that be called if I was actually there in your studio? Can I come out?
I think we could. It would just be broadcasting. Oh, Macro Man. I like Macro Man. The Macro Man.
The Macro Mountain Man. Yeah.
Yeah. I mean, I'm going to be here. I don't go anywhere. And then because when you go to your place in Maine, a little farther south than us, once you go there, you don't like going anywhere. Why go anywhere?
We do. We don't. So we've been going there for my whole life. And when people come visit, we do the tour, right? So from where we are down in York, Maine, my dad likes to call it Tour A, Tour B. Tour A, you go up towards the Bush House, right? You've been down over to George Bush's house, beautiful place out in the ocean. And you go up to Algonquin and you kind of go all right, Candy Blinkport, and you kind of drive all along the coast. And, it involves, we're right over by the Nubble Lighthouse, which is over there, in New York. But frankly, we'll go there for a week and I go to the grocery store. That's it. The kids can walk over to the beach. I don't go anywhere because it's just beautiful to just hang out and do nothing.
Yeah, I'm fully in that hang out and do nothing mode. Although I come into the office and I talk to my students every day, but for the most part, I don't really go anywhere. But the market for us, like, we're still watching, right? So we just had this big rally today, and all of a sudden, all the rallies start to fade. Garrett just said 7,400 is the line in the sand. I think we're going to be there in like 3 seconds.
It's the way it's going. It's going to be a couple seconds. So right out of the gate this morning, I noticed what was different is that the Russell was leading the rally. If you look at your charts, the Russell looked like it wanted to go take out Friday's high. I think it almost tagged Friday's high, but it was leading. It was a big spike right on the open.
Holy gosh.
Yeah, look at that. So it took that up, and then that was kind of dragging the market. What I noticed in the sector stuff was housing, home builders. They were leading. Funny enough, there was a home sales number. Existing home sales came in a little hotter than expected, 2.6 to 2.4%. Home sales were a little hotter, and existing home sales was 3.2% to the survey of 1.1. How did they know? That was up before the number came out. They always know somehow. I hate when they know. How do they know? But you had home builders, retail, mid-cap financials, XLF, consumer discretionary. All these things are leading. It's like a broad-based pullback. Like the NASDAQ's red, right? So like this idea that we are having this bounce back from a Friday sell-off, it was spread. The rotation we talked about last week, this rotation's flowing through the market. It's money coming out and taking, it's people taking some money off the chip table. It's like they're pulling their chips back. Like you're in Vegas, you're going to pull your chips back. They're taking their semiconductor money a little bit off the table. You got to spread it around. You don't just go to cash. People don't go to cash, money managers don't, right? So the real big money, they can't just go flat. You're not allowed to go flat. You have to be long.
Right.
So what are you going to buy? You're going to buy, well, I don't want to buy any more chip stocks. Let's go buy some stuff that's unloved. And that stuff that's unloved is in the retail sector, in the home builders. If you're going to have rates kind of pause, possibly, again, it's not, this is the biggest question is how is this inflation number? How are these inflation numbers going to settle up? We got CPI again. That's a big number tomorrow, especially considering we got Warsh next week. Our first time getting to hear Warsh. I'm excited because it's something different. Every Fed governor has their fingerprint and kind of their style and how they handle the markets.
Right.
And this is our first chance to see him. From everything I've read, and then I've heard him talk, he seems to be somebody who's going to move faster. He said he's willing to move faster on both sides. They want to kind of get rid of the dot plot, is what he said. I want to get rid of that dot plot. I feel like he felt like forecasting so much was a mistake because they get anchored to whatever it is they're doing, right? So it's like if they forecast out, we think here's where we're going to be. They're like, well, we told everybody we were going to be here, but we want to change because the data changed. They kind of can't. So they get married to those predictions. Whereas he said, look, I want to throw that out. And I just want to do whatever we're supposed to be doing based on the data.
Right. And one thing about the data that's come out is earnings have been tremendous, right?
Yeah.
Everywhere. I mean, stock valuations are high, but the earnings have been really good.
Yeah.
All the data keeps coming. The employment number was better than everybody. All the data keeps coming in better than everybody expected. Now, you can't cut on that. No. For those of you that remember, we went the whole 90s with interest rates 4 or 5%, but obviously the government was not running the deficit they have. So and the whole point is we've never had the rubber hitting the road yet with with spending since 2020. Nobody is doing anything. to reverse that trend currently, either party that I can see anyway. They're both kind of sticking their head in the sand on it and just hoping for the best. But and I think that's, and we find ourselves where all the data is actually pretty good, but the market's already at an all-time high, and we're stuck now with how do we keep the ball going? Of course, Garrett's saying they're going to keep printing money to keep the ball going, but Warsh comes in, and I think the next Fed meeting is usually right on VIX expiration, right? So next Wednesday,
I believe it's next
so you're going to have CPI, PPI. You're going to have the IPO from SpaceX Friday, the next Fed meeting. So all of a sudden, like option volatility or option prices, like even the SPY IWM, you have 4 events coming down the road in the next week. So I think, at least from the market's point of view, VIX tried trading 17.5 or lower today. It looked like it was trying to pull back a little bit, and now all of a sudden everybody's like, maybe not so much. But I think when you look at it, the SpaceX IPO is so when you were trading and you're trying to price options, Tim, when you're pricing them, the thing that was hard to price was like the infinite upside.
Oh my God. Yes.
Yeah. And I think at this point, right, with all the chip stocks have made these big moves, how is the market going to price? Or if people see the SpaceX IPO, basically, the infinite upside for the IPO, just, a huge boom on the upside. I think, again, going into Friday, I think that could be ultimately the animal spirits will come out on that one. But
that IPO is it's oversubscribed by a lot. From what I read, it's actually oversubscribed. I'm not bidding. I didn't get any, and I don't actually want any on the 135. I'm bidding $100 for it. And why 100? Because I want a 20% dip in that thing. I'm not interested right here. I feel like it's such a cool stuff. We'll talk about SpaceX Friday when it comes out.
Right.
The point is, it's oversubscribed, but they're only offering 5% of the company. They're trying to raise 80 billion, 70 billion. And it's funny because I think we talked about this the other day, and I said, what's the difference between 1.77 trillion and 1.8 trillion? It's 30 billion. That's the rounding error between what the IPO is going to be and what it is, or whatever rounding. And they're raising capital to the tune of a rounding error, which is kind of crazy, right? They don't need the money. They just want to have the print. They want to basically, as soon as they go IPO, everybody who's long that stuff can say, hey, I got this collateral. I got this money, and they can borrow against it. So it's financial engineering, super smart people doing this. You can't count them out. Like, it's really, really, it's cool. So I'm like, from a trader standpoint, I'm not buying it. I don't really trade it. The closest to IPO I ever traded, because we traded options, was Google. They listed those Google options like straight away.
Right.
I don't know if you remember that back in like 06 or something like that.
Oh yeah, it was a while ago. It was like,
that was fun. Oh my God, that was haywire. Like, it traded so much. Like, it was so busy, and it was like a fun thing to trade. But I didn't make the call. Like, what can we do about all this stuff? Like, how do we, what does this mean for everybody here? Well, Anthropic is looking to IPO. ChatGPT, OpenAI, they just filed yesterday. It looks like they're going for like a $900 billion valuation. They're raising about 122 billion. So raising, not quite double what SpaceX is. Now, they talk about a company that needs money. OpenAI needs some money, right? They are burning cash like it's, wood at a campfire. I mean,
And this is their moment. It's almost like it reminds me of when Facebook IPO'd. And it IPO'd at what everybody thought at the time was a very high valuation, like 50 or 80 billion dollars or something like that. It was at the time pretty high. What, about 10, 15 years ago, whatever it IPO'd.
Yeah.
And then the stock IPO'd at 40. It had that one-day print where it ran to 60, and then ever since then it dropped straight to the teens.
Yeah.
And Facebook never needed the money either. I don't think they've ever had a problem with it. So, and I think SpaceX will probably, I'm going to guess it will, kind of run that same pattern, but we'll have to see.
You talked about earlier something, I think it was Bank of America put out, they had 17 to 20 valuation measures were somewhere in and around like a very bearish indicators. And, a lot of it's, I'm so torn right now because a lot of the historical things that I look at, the way I look at the markets, I'm seeing I see all these like bearish signs, right? So a bunch of IPOs are starting to hit the market, right? They usually come in, they're like, I want to kind of raise my market. That's to me, that's a tell, right? When I see call skew go insane, like we saw in the chip side, like, oh my God, if a stock is rallying and its vol is rallying, everybody, like if a stock's rallying and the vol is rallying, historically, you close your eyes, you just start selling and you just start buying puts or selling. Again, you got to have a lot of capital, you got to risk management, but like that's a hugely bearish sign. But if you're going to have a repricing of stuff, like we talked about, I think it was Hans and I were talking about, Micron is a different company. NVIDIA, totally different company. Obviously it's already a $5 trillion company, but on the way from, let's say, 500 billion or a trillion to 5 trillion, it's a different company. And so you kind of, some of these historical signs, you got to be aware of the times that we're in.
Right.
So I'm taking stock in this stuff. I'm looking at, all right, I got one side of me is very bearish, seeing all these bearish signs that consumer confidence is really bad. And like, there's a lot of indicators. There's like some credit stress. There's like stuff that's like making me bearish, but then there's all this other stuff. It's like, but there's like a new wave on our hands. So I don't want to get caught up in the 2000s. You get to go buy the high like Druckenmiller. I don't know if you remember the famous story where he went and just he called uncle and he just got mega long right at the top.
Right.
I'm very cautious. Like I feel like I'm long some stuff, but I'm flipping. I'm in and out. I have stops, and I think the way looking at the markets, I am on the idea that like there's a rotation through here. There is more upside in some of these unloved sectors, but we got to see it through the data, and you could be patient about some of this stuff.
And people will be able to do that in August with you, correct?
That's right. So I was hoping to be launched earlier, but when you take some time off from trading, I'm starting to get in a groove. You remember what type of trader you are, and I think I'll talk a lot about this as we launch the service. Identify who you are as a trader. Think about the way your personality style. I don't know if this is like with you, Andrew, but I remember when I was I think it was interviewing or right after I got hired. It was the HR manager who picked me out as a type of a trader. He goes, "Oh, I know. I can see your personality. I can tell what type of trader you're going to be." And I thought he was nuts. Like I had never traded before, but like I'm a very patient person and I like to analyze stuff. Right. And I did really well when I was in a pit that you could, do a handful of trades a month and you got to think about them and you got to sit on them and do that type of trading. Do you notice that with yourself? Your personality suits your trading style?
Yeah, I'm 100% convinced everybody trades their personality. You can't get away from it. Because I've been teaching retail now here for retail. I'm retail. You're retail now. We're all just we have to take what the market makers give us. So we're all retail. But everybody trades their personality, and you can't fight it.
Yeah.
And then some people, obviously, their personality is not suited to trading.
That's true. Yeah.
So it's better just go buy the SPY and forget about it. Which is, but for people that want to trade now, I will say one thing. The SPY is up 157% from the bottom in 2022. I believe that was the kind of the inflation bottom. Was it 2022, 2023?
Yep.
So SPY is up one now. The bull market in the 90s, from the bottom tick, it did rally 500 and something percent. So when you did say companies, a $5 billion or $5 trillion company moving to 10 is a different story. Just let you know, historically, there's precedent for the market deciding to take off, even though you've had a pretty good bull
Yeah.
run.
Yeah.
It's not the first time it's happened.
Right.
It's happened many times. So again, I think that's a good reason for people to keep subscribing to Option Pit. So
Yeah.
we're at kind of the halfway point of the hour.
Yeah. I think that, like you said, I think the biggest point there is, again, for everybody watching, we have 6 traders now. I think seven traders, including Boz. Look at the people, join the rooms, look at the stuff that we put out there, connect with people. Like when you find something that you're connecting with on a personal level and like a style or a flavor that you feel comfortable, like that's going to work for you. I feel strongly about that. And I don't even know anybody out there, but I've met so many traders. You've been doing this side of the business for so long. That's a really good tell of like what style is going to work for you is trade your personality. Like it's kind of a weird thing to say, but it really is. It's a huge edge in that sense because you'll be more relaxed.
It's also you accept it. I think it makes it a lot easier. You definitely have to trade your personality. So speaking of that, Voz is opening up Wednesday, Thursday, Friday of this week. Trade to close. Right. I think first time ever.
Yeah.
For people that want to pop in and check her and Mark out, I am going to be doing a 11 o'clock on Thursday, an open house for weekly profit cycles, helping you set up the moonshot trade, going through all of this, basically how to trade market tops. That's the idea. How do you trade market tops and like not go to sleep and freak out all the time? And then of course, Tim will be around. Hopefully August. We're looking forward to his macro. Tim will be putting out his trading product for us. And I guess that's it for today. Like look for the big numbers, right? We've got 4 big events coming, 2 numbers, SpaceX, and then a new Fed chairman. So with that, I'll see my students at Rip Zone shortly. And and with Tim, thank you for coming. And I'm going to see you in a couple of weeks.
Yes. Looking forward to it. Thanks, everybody. Have a great day.
Have a good day.